Good morning and welcome to the Killik and Co-Market Update. We've had some significant news from Japan this week. While the UK, the US and Europe have all been raising interest rates for the last 2 years and are now at the point where they're looking to start reducing interest rates, Japan, until this week, had not raised its interest rates since 2007. This week, Japan finally made the move and it raised its deposit rate from minus 0.1% to positive 0.1%. Here's where the Japanese rate has been over the last 20 years. You can see the rate has always been relatively low. Even in 2007, the rate was only 0.5%, and for much of the last decade, the rate has been negative. Part of the intention behind this negative rate has been to discourage people and businesses from holding cash and to encourage them to invest and to spend. Despite having such a low interest rate, which in theory should create demand, Japan has historically had a problem with deflation. Here's Japan's CPI over 30 years. When it drops below that dashed line, the inflation rate is negative and therefore prices are falling. This can create a negative spiral. If consumers expect prices to fall, then they will keep delaying purchases, and this is bad news for economic growth. The negative interest rates that were in place from 2016 onwards did have a positive impact on the Japanese stock market. Here's the Nikkei 225 since 1984. You can see the market had a significant crash in the early 1990s, and that's referred to as the bursting of the Japanese asset price bubble. And it struggled for years after that. But the last decade, though, has been positive, and the Nikkei 225 has finally gone above its 1989 level. And also this week, the US Department of Justice has announced a case against Apple for abusing its market power and illegally suppressing market competition. Apple shares dropped about 4% on the news. Apple has significantly outperformed the S&P 500 over the last decade, but it has been underperforming of late. Here's the 10-year chart. Apple is in the pink and the index is in the green. But here's the 1-year chart. The index is up 30%, but Apple shares are only up 8%. Apple is certainly not the only company that's being accused of abusing its dominant market position, and it does feel as though regulators around the world are becoming concerned about the biggest companies getting bigger. We have mentioned in this video several times before that the top 10 companies in the S&P 500 now account for over 30% of the index. Apple at the moment is worth 5.9%. And finally this week, here in the UK, we've had the latest inflation data and the latest interest rate decision from the Bank of England. Inflation dropped from 4% all the way down to 3.4%, and the next day the Bank of England opted to leave interest rates on hold. But in some commentary after that interest rate decision, the Governor Andrew Bailey did suggest that good progress has been made with inflation and that interest rate cuts are not too far away. Investors in the UK's AIM market will be hoping that lower interest rates will improve their fortunes. Here's the index over 10 years. Unlike most large company indices, it has yet to recover from its 2022 fall. Next week, it's looking fairly quiet in the run-up to Easter, and we don't have any companies on the Killik covered list reporting. So that leaves me to wish you a very happy weekend, and I look forward to seeing you next week.